Hello and welcome to another episode of PS Perspectives. I'm Sam Nussbaum and I'm joined by my colleague Corey Clermont.
Hi, Sam.
Thanks for joining us, Corey. Corey and I are asset allocation specialists here at DoubleLine, so we focus on our multi-sector fixed income portfolios. And today we thought we'd take the opportunity to talk about fixed income returns so far year to date in 2023, what's been driving those returns, and how we've been positioning our portfolios with our economic outlook in mind. So with that, Corey, can you kick us off and talk about fixed income returns across the asset class?
Yeah, of course, Sam. So up on the chart here, you'll see fixed income year-to-date performance across various asset classes. And just looking at this chart, it's been a pretty strong start to the year for fixed income asset classes with returns anywhere between 3 to 5%. You have Treasuries up 3.6%. Investment grade corporates are up 4.3%. But the leader in the clubhouse after 4 months is U.S. high yield corporates. And it's really been due to three reasons. One of that being duration. The high yield asset class is keyed off the 5-year tenor across the U.S. Treasury curve, and the 5-year fell the most over this time period, benefiting overall price returns. Secondly, you did have credit spreads tighten in a little bit. They tightened in about 17 basis points, again, aiding positive performance. And then lastly, you had, as the name implies, a higher yield or a higher carry for taking on that below investment grade credit risk. Moving to the right-hand side, you'll see securitized credit. Those are the gray bars there. And securitized credit generally lagged that of investment-grade corporates and high-yield corporates, and that was primarily due to having less interest rate sensitivity relative to those two other asset classes. The one outlier, Sam, is going to be your commercial mortgage-backed securities rated BBB. And while there is a lot of headlines, negative headlines out there, and for the brevity and format of this show, I would recommend going to Jeffrey Sherman's The Sherman Show podcast. Last week, he had on portfolio manager Morris Chen, who's the head of commercial mortgage-backed securities, and they discussed the asset class in great depth. And they talked about our outlook as well as some of the opportunities and some of the issues within commercial mortgage-backed securities. But Sam, looking at this year-to-date performance, it was really a tale of two markets. And looking at the next slide here, what you're looking at is returns since the start of the year through March 8th. And the reason that we picked March 8th is because Silicon Valley Bank became a household name, right? There was liquidity problems and it started the regional bank crisis as we know it. And so you'll see on this chart that a lot of the returns were driven by credit, right? Credit outperformed. There was a risk-on rally and credit spreads tightened. And you'll see high-yield corporates rated CCC, they were up 6.3% through this time period. Now, fast forward, after SVB became a household name, March 9th through April 30th, you'll see the return dynamic shifted quite significantly. And these returns were primarily driven by duration because rates across the U.S. Treasury curve fell. And so longer duration assets such as U.S. Treasuries as well as investment grade corporates really outperformed. But Sam, I talked about from a high level some of the duration impacts on these asset classes as well as credit spreads. But can you dive in deeper in terms of what the U.S. Treasury curve looks like, what tenors did, as well as where we stand with credit spreads today?
Yeah, sure. So when we're talking about duration as it relates to fixed income returns, what we really want to illustrate here is the changes across the U.S. Treasury curve. So we've shown 4 tenors of the curve here from the 2-year out to the 30-year bond, and you can really see that yields on Treasuries sold off in the beginning part of this year, right up until that kind of mid-March period, and then there was a strong repricing pretty much across the curve into the end of April. So what that tells us is that, specifically on the 2-year, is that rates sort of peaked out, in that kind of early March period, and then really tightened back in again. And if you look at spreads on corporate credit, it has somewhat of the same look. We've broken out here the investment grade cohort of the corporate bond market on the top panel, and the below investment grade cohort on the bottom panel. And you can see here that in that first part of the year, to start the year, spreads rallied pretty much across the board in investment grade credit and below investment grade credit, particularly the CCC rated portion, the lowest rated portion of below investment grade bonds had a pretty strong rally to start the year. Then spreads widened out in reaction to that regional banking stress breaking out, as you pointed out. And then spreads rallied a little bit. Spreads across investment grade corporate bonds pretty much unchanged year to date. And then spreads on high yield corporate bonds are still in a little bit. So we've had a bit of spread tightening. Now, the takeaway I think here for investors is that market participants in this corporate bond market are pretty sanguine about the U.S. economy, right? Spreads, pretty much unchanged or slightly tighter on a year-to-date period, given all of the headlines that we have surrounding financial stability, is pretty telling. And I think we would contrast that sort of outlook a bit with our view here at DoubleLine, which perhaps is a little more cautious, given leading indicators of the economy and given some other dynamics kind of within markets. One of those we wanted to draw our viewers' attention to here is bank lending standards. Now, we have an economy that certainly has seen some tightening of bank lending standards already, and we would expect, given all the news in regional banking, the consolidation across that part of the economy, that would lead to a further tightening of lending standards. Now, the problem with that for the economy is that bank lending standards tightening tends to be highly correlated to a rise in corporate default rates. And so when we think about how you're being compensated as a fixed income investor based on spread of various sectors, we want to be cognizant of how much risk that's pricing in, right, in the securities should there be a rise in defaults. And that's broadly speaking what our team's been focusing on here at DoubleLine as it relates to our multi-sector portfolios is we've been upgrading the quality across those portfolios, both from a credit rating standpoint and from when it comes to securitized credit, from an improvement across the collateral composition of those securities. And we've been running a duration in these portfolios that's kind of more in line with our benchmark index, which, should rates fall in an economic weakening type of scenario, you would benefit from that duration, right? But there's still opportunities across the space, right? So maybe you can take us through some opportunities as quantified by spreads across various sectors of fixed income.
Yeah, so this chart here, Sam, is just looking at the spreads of various fixed income indices relative to their 10-year history, right? And there's a lot going on in this chart. So just taking a step back and explaining it, on the y-axis there, you're looking at the percentile ranking of the current spread level versus its 10-year history, right? And so a 50th percentile ranking would mean that the current spread level is on average with its 10-year history. Something closer to 100 means that it's a lot cheaper, right, relative to its 10-year range. And so on the x-axis, what you're looking at is the nominal spread level over treasuries. And so, for example, bank loans, right in the middle of the screen there, you'll see sitting on that dotted line, which shows that it's in the 90th percentile. So it is relatively cheap comparative to its 10-year history. And then it's also sitting at a discount margin of about 600 over. And so you mentioned earlier investment grade corporates and high yield corporates, right? Not necessarily pricing in some of the economic risks that we see out there. And you'll see that they are about at the 65th percentile. So they're a little bit cheaper than their 10-year history. But again, looking at this chart, you'll see that there are a lot of other asset classes out there that are a lot cheaper comparative to their own 10-year history. Some of those being agency mortgage-backed securities, commercial mortgage-backed securities, rated AAA, as well as commercial mortgage-backed securities rated BBB. Now, Sam, this is just one key metric that we look at here at DoubleLine as allocators of capital in terms of relative attractiveness across the fixed income universe, because just because BBB CMBS is rated in the 95th percentile doesn't mean we're necessarily going to be overweight there, right? It's just one metric that we're looking at here at DoubleLine.
That's right. And our fixed income asset allocation strategies have a pretty broad opportunity set, right? Which we can look across the asset class and find these relative value opportunities. And I would say on top of that is, we have to, as allocators, try and outperform over a range of future scenarios relative to our benchmark. And some of those scenarios could include economic weakness, right? So thanks, Corey. Appreciate you being here. And thanks to our listeners out there. If you'd like to find more insights like this, please go to our website at doubleline.com. Thanks.